Hello everyone. Hello, welcome. Welcome to you all. Welcome all of you. I welcome you all to today's session. My name is Afreen Azmat and I am your PPB and IFS educator in English medium. So, this is a chapter that is lecture 15. The name of the unit is Theories of Interest. Okay. So, in this chapter, we are going to discuss some of the important theories. Okay. The overview of the theory and related questions for that. Okay, so let's start discussing the topic. Okay, first of all, if we talk about the introduction, first of all, what is interest? First of all, we are concerned with what is interest, what is termed as interest. So interest is the payment made by the borrower for the use of the sum of money for a period of time. So if you are borrowing any money from the institution or banking or from someone or some individual also, if you are borrowing some money and on behalf of this money, if you are using this money, you are paying some extra fee for that, and that is known as the interest. So interest is actually the payment which is given by the borrower on the behalf of the payment that is being utilized by them and that is being borrowed by them. This is known as the interest. Okay. Now, if we talk about the elements that are distinguished in interest, what are the three elements which are different in interest? For example, first of all, it is payment for the risk involved in making the loan. So, whatever the loan you are giving, whatever the loan the creditor is giving, it is actually a payment for that risk. Okay, if you are paying some extra percentage, it means that you are paying some extra money for the risk that is involved in the process of giving loan. Next, if we talk about the payment for the trouble involved, see, obviously, if you are giving loan, if any bank is giving loan, there are a lot of trouble that is involved with that. For example, if we talk about the troubles like bank has to do KYC, bank has to do all the background checks before giving you the loan. So there are obviously lot of troubles that is involved in giving you the loan, and interest is the payment for that also. Third, pure interest, this is a payment for the use of money. Now there's a pure interest which is actually for those or what you are using. So this is the main three thing of the interest. First of all, interest is considered as the payment for the trouble that is involved in the process of giving loan. Interest is also considered as the payment for the risk that is involved in making loan. Third, this is the pure interest. There is a pure interest which is actually charged for using that money for a certain period of time. This is known as the interest. Okay. Next, if we talk about the differences in the interest rate, so differences in interest rate on different loans during the same period must be there, and therefore due to this differences there are risk and trouble that is involved in the loan. For example, there are same amount of loan which is disbursed to two different customers, but the interest rate can be different for these two customers, it depending upon the profile of the customer, the risk involved in the process. For example, the one customer has a good profile maintained with the bank, they have a good salary, they have the good, do the regular financial transaction with the bank, so obviously bank gives some discount in the interest rate to them. Whereas there is some individual which are not engaged in a regular financial transaction with the bank, nor they have their salary account in the bank, and that's why the amount of interest that is charged for the same loan to them is actually higher, little bit higher. So if you are dispersing the same amount or same type of loan, the interest rate can be different depending upon the profile of the customer and depending upon the risk that is involved in that processes of loan. Okay. Now, if we talk about the classical theory of rate of interest, now let's talk about the theory of rate of interest. Now, the first theory of the rate of interest is considered as classical theory of the rate of interest. Now, what is classical theory? First of all, it has also known as the demand and supply theory. This theory is also known as demand and supply theory. Next, it has developed and modified by the renowned economists like Marshall, Fisher, and Pigou. Next, if I talk about this theory, rate of interest is the equilibrium of demand and supply of saving. It says that the interest is a price paid for supply of the saving to meet the demand of the investment. Demand for investment. Now there are two things. There is a demand for investment for which there is a supply of the saving. Now these are what? First of all, we are talking about the demand for investment. Now what are the demand for investment? Demand for the investment, for example, there are business and corporates and individuals who want to have the funding in order to carry out some projects. Okay, now business wants some funds to carry out their project, individual wants some funds to carry out their project. So there is a demand for investment to the public. There is an approach of the corporate and business and industries which they are offering to the public that okay, I am going to start this project and I want you all to invest some amount in this project, and once this project is completed, then the profit is distributed among we all. This is known as the demand for investment. So obviously there is a demand for investment which is coming from the corporate, or which is coming from the industry, or which is coming from the multinationals. And there is a supply of saving. Supply of saving means there is a saving which is uh, which is actually held by the general household. Now for example, I am earning for example 2 lakh rupees a month. Now there is obviously some expenditure which I am doing, and the rest amount is actually what I am saving. Now if there is a demand for investment that is raised from a corporate, and if I am interested to invest in that corporate, I use my saving to invest in that corporate. Obviously, the money which I have saved, not the money which I have spent. So there is a demand for investment raising from the corporates and multinationals and the general institutions, and there is a supply of saving from the household side. So this Ragnar, Frisch and Figo and these all says that when we are talking about the classical theory of the rate of interest, the classical theory of the rate of interest is the equilibrium of this demand and supply. Means when the demand of the investment is actually met up by the supply of the saving, when there is a point of interaction between demand and supply, the interest rate that is arised from that, it is known as classical theory of the rate of interest. So obviously basically they what they meant, or what they are meant to say, that interest is the price that you are paying for the supply of your saying, or sorry, that you are receiving for the supply of your saving towards the demand of the investment. Means there is a demand for the investment which is raising, and if you are supplying your savings by yourself, if you are supplying savings by yourself, so this savings is actually meeting the demand for that investment, and therefore the interest is arise from this demand and supply, and interest is considered as amount that is being paid to you because you are supplying your savings for meeting the demand of that investment. So this is known as the classical rate of interest. This is known as the classical rate of interest. Okay, so this is what which is meant. This is also known as the capital theory of interest or saving investment theory of interest. So classical rate of theory of interest, I hope that you all have understood. So two main thing: demand for the investment and the supply of saving. The equilibrium of these two is the classical theory of the interest. Okay, next. Now this I have already explained: demand for saving and supply for saving. Demand for saving is what? Demand is actually for investment that is raised from the corporates and publics and nationals for completing their project. But there is a supply of saving, obviously, from the household side, the money which they are saving. If they are interested to invest in any type of project, they can, or they are free to invest, and therefore they are providing you the money, and therefore the demand, the public, the corporates which are actually receiving that money pays interest for the supply of your saving. Clear? Done? Now next, if we talk about the classical theory interest rate, equilibrium and criticisms. Okay. Now next, now there is the Keynes liquidity preference theory of rate of interest. Now there is a classical one thing that simply says, okay, there is a demand, there is a supply, and the meeting point of these two is considered as the classical theory of rate of interest. Now there is a Keynes liquidity preference theory of rate of interest. Now what is this? So for this, if we talk about this theory, this is actually present in the book The General Theory of Employment, Interest and Money, which has been written by J.M. Keynes. Now this theory is actually giving you the concept that interest is purely the monetary phenomena. It is determined by the demand for money and the supply of money. Okay, so it actually gives you a new view of interest. And according to him, J.M. Keynes says that this rate of interest is actually the purely considered as a monetary phenomena, and it is determined by the demand and money supply, or money or supply of money. For example, if we talk about the demand for money, in order to explain the demand for money and the interest rate determination, they assumed a very simple concept where there are two assets which the people can keep in their portfolio balance. For example, money in the form of currency, which can earn no interest, and long term bond. It is important to note that the rate of interest, the bond have the inverse price. So this is very important. You have to learn this, that the rate of interest and the bond price are inversely related with each other. How they are inversely related with each other. For explaining this, once I have to explain what is bond. What is bond? So bond is actually the demand for investment. Bond, for example, there is a corporate bond. Bond is fixed income bearing instrument. Bonds are what? Bonds are the fixed income bearing instrument that is actually given. For example, corporates are issuing bond. It means that they are raising capital. They are raising the what loans or borrowings in the form of the bonds. Bonds actually says that, okay, whoever the holder of this bond, the corporate is responsible for giving this person this amount of money after a certain maturity. So it actually represents the indebtedness of the what indebtedness of the corporates. So if the corporate want to issue capital, they can issue capital, they can issue or they can raise borrowing by the issue of the bonds. Bonds, the main important thing is bond always carry a fixed amount or fixed income, yearly or half yearly, which is known as coupon rate. So there are three things which are involved in a bond. Bond is what? First of all, this is clear. Now two things, there is the interest or which is known as the market yield, and there is the coupon rate. Coupon rate is the fixed amount of interest that you are receiving from the bond yearly or semi-annually. For example, there is a 5% coupon rate. It means that in favor of the money that you have given for purchasing of the bond, you will receive a 5% interest annually as an income, and the maturity amount obviously after the maturity of that bond. So you are receiving 5% annually as an income, which is known as coupon rate. Coupon rate is fixed throughout the lifetime of the bond. If bond is for 7 years, the coupon rate will be for 7 years. Now, if there is an interest rate, interest or market yield, what is the interest or market yield? Interest or market yield is representing, means what the uh, new yield that is given from the bonds which actually have the same risk and maturity. If the bond is having the same risk and maturity as the previous bond, now what is the new total income or total interest that you will receive in the market? What is the current market rate for that? It is known as the market yield or market interest rate. For example, there is a market interest rate of 6%. Now please just listen the example carefully. Now there is a market interest rate of, for example, 6%. It means that there is a coupon rate which is, for example, 5%. Okay. Now there is the market interest rate which actually rise above this coupon rate, for example 6%. Means there is a market interest rate. If there is a interest rate increase in the interest rate of the bond, it means that the new bond actually giving you 6% return in comparison to the old, which is actually already issued and the coupon rate is 5%. Means in old bond is of same value, same maturity and same risk. Now the older version is giving you 5% coupon rate, means you are earning 5% annually. But now if this is issued for the new, this will give you 6% return. Now obviously, if you are seeing that okay, the bond has the same risk, the bond has the same maturity, but the new is giving me the 6% interest rate, older version is at 5%. So obviously the new investor will be attracted towards this 6%, obviously. Now the older version is actually what, out of the competition. And for this to maintain in the competition, because you are holding that bond, now your bond should be of value. Why? Because if you want to sell it further, then there should be party enough for buying this. So you do what? You actually reduce the value of this bond. If the value of this bond is actually reduced, then obviously you are inviting people to buy this bond at a lower price than this bond. Means now there are two options. Means this will give you less coupon rate but at a low price. You will have to give me less price for purchasing this bond. Now you have to give more price for purchasing this bond, but the interest rate is high, 6%. So they are equally in competition. So when the interest rate rises for the bond, the prices of the bond should be reduced so as to maintain the competition of the bond. For example, I have given you the example that if the bond is providing you a 5% coupon rate and the market interest rate rises to 6%, now the new investors obviously attract towards the new deal, which is giving you the 6%. And if you want to maintain the competition of your bond and you want to maintain the, you want that the buyer should buy your bond, then you should do what? You should reduce the price of the bond to remain in the competition. And vice versa is also true. If the market interest rate goes down, the bond price will increase. How? For example, if the coupon rate is, for example, 5%, now the interest rate for the market is, for example, 4%. Means the older version is giving you 5% return and obviously new is giving you 4%. All the investor will be attracted toward this older version. And because this is in the demand, so obviously the price of this bond will increase. So always remember, if interest rate rises, the bond price will decrease. And if interest rate decrease, the bond price will increase. There is always an inverse relationship between bond price and interest rate. Clear? Yes or no? Yes or no? Everyone who is watching the session, just please like the video, guys. Done? So this is the bond price and the inverse relationship. Okay, so this is it for today's chapter. We have learned only two concepts today. First, how the bond price is inversely related to the interest rate. What is bond? And I have explained you the classical theory of the rate of interest, which says that the rate of interest is actually the origination, or actually the point, or actually determined by the demand and the supply equilibrium. There is a supply for the saving and the demand for the investment. When these two meet, the rate of interest arises. Okay, so thank you so much everyone who have joined this session. Please like and share the video, and if you haven't subscribed this channel yet, guys, please subscribe the channel and press the bell notification icon. Thank you so much. Bye bye. Take care everyone. Bye guys. Take care.